Investing can be challenging. Even experienced investors who try to time the market to buy at the most opportune moments can come up short. Dollar cost averaging is a strategy that can make it easier to deal with uncertain markets by making purchases automatic. It also supports an investor's effort to invest regularly. Dollar cost averaging involves investing the same amount of money in a target security at regular intervals over a certain period of time, regardless of price. By using dollar cost averaging, investors may lower their average cost per share and reduce the impact of volatility on their portfolios. Dollar cost averaging is a simple tool that any investor can use to build savings and wealth over the long term. It is also a way for an investor to ignore short-term volatility in the broader markets. A prime example of long-term dollar cost averaging is its use in 401k plans, in which employees invest regularly regardless of the price of the investment. With a 401k plan, employees can choose the amount they wish to contribute, as well as those investments offered by the plan in which to invest. Then, investments are made automatically every pay period. Depending on the markets, employees might see a larger or smaller number of securities added to their accounts. Dollar cost averaging can also be used outside of 401k plans. For instance, investors can use it to make regular purchases of mutual funds or index funds, whether in another tax-advantaged account, such as a traditional IRA, or a taxable brokerage account. Let's look at the benefits of dollar cost averaging. Dollar cost averaging can lower the average amount you spend on investments. It reinforces the practice of investing regularly to build wealth over time. It's automatic and can take concerns about when to invest out of your hands. It removes the pitfalls of market timing, such as buying only when prices have already risen. It can ensure that you're already in the market and ready to buy when events send prices higher. And it takes emotion out of your investing and prevents you from potentially damaging your portfolio's returns. Let's say you invest $100 every month. When the market is up, your $100 will buy fewer shares. But when the market is down, your money will buy more. Over time, this strategy could lower your average cost per share compared to what you would have paid if you bought all your shares at once when they were more expensive than the average. Let's take a look at how dollar cost averaging works. As you can see in this chart, dollar cost averaging enabled the investor to take advantage of a price decline in month 3, significantly reducing the average cost per share. Despite paying $4 or more per share in 4 out of the 5 months, the average cost per share came out to $3.70, and the investor was able to purchase a total of 135 shares. By contrast, had an investor made a one-time purchase of all $500 in month 1, the average cost per share would have been $5 for a total of 100 shares. The key advantage of dollar cost averaging is that it reduces the negative effects of investor psychology and market timing on a portfolio. By committing to a dollar cost averaging approach, investors avoid the risk that they will make counterproductive decisions out of greed or fear, such as buying more when prices are rising or panic selling when prices decline. Instead, dollar cost averaging forces investors to focus on contributing a set amount of money each period while ignoring the price of the target security. It's important to consider your risk tolerance, investment goals, and time horizon before deciding if dollar cost averaging is right for you. Ultimately, the best investment strategy is one that aligns with your unique financial situation and goals. If you have found value in this video, a big thumb up is appreciated. Thanks for watching this video, and don't forget to subscribe to our channel for more financial tips and advice.